Welcome to the Grow Your Business and Grow Your Wealth podcast with Gary Heldt. Gary is an expert in helping business owners put together a plan that will provide a better future for their businesses, themselves, and their families. On the podcast, Gary interviews other professionals who share his vision, and together they share secrets and strategies any business owner can use to build a better financial foundation for your business and your life.
Hey, welcome back to the podcast. This week, our guest is Darin Davis, and he is the principal at Club Capital. Welcome, Darin.
Hello, Gary. How are you today?
I'm doing great.
Wonderful. Thanks for having me, by the way. Appreciate it.
Sure. I'm looking forward to our talk. So tell me, Darin, how did you get into the real estate, the capital arena? Well, kind of tell me your background.
Yeah, it's not super exciting, but there's a couple little quick twists that make it a little more exciting. I was probably like most people after I got out of college. I had a bachelor's in business administration, and I took back then there wasn't just tons of different fields to go in. I mean, I went into sales and marketing, and fortunately I did pretty well, and I kept getting elevated and was making good money. But after about 15 years, I started going like, you know what? I'm not in control, and I'm working hard Monday through Friday. I mean, I ended up out in California working for a couple startups, one of them being Yahoo, which we all are pretty familiar with that brand. And, when they were acquired broadcast.com. But what I found out I was doing is it was Monday through Friday. I was on a plane. I was managing several salespeople, and, it was fun. I was doing well, but I just kind of said, I don't know if I can do this another 15 years. And then you have a life event. My father unexpectedly passed, and that kind of sunk in. And then my grandfather a few months later, but I just said, I want to do something different. And quite frankly, I didn't know what different was. I mean, I was just going like, I don't know what it is. I got to figure this out. And I kid you not, this story will probably resonate with a big portion of your audience. I'm driving from San Francisco down to San Jose, down to Yahoo for work. And on the radio, I hear this guy, AM radio, of course. That was our form of education back then. But I'm listening to this guy on the AM radio, and I'm just fascinated by what he's saying. And I keep listening. I'm going, I got to figure out who this guy is. It's getting towards the end, and I'm in my parking lot. I'm at my office. I said, well, I got to figure out, I got to sit here and listen to the last 10 minutes of this. And sure enough, the host closing it out and said, you know what? Thank you, Robert Kiyosaki. This is a great interview. And I said, oh, how do you spell Kiyosaki? I got to write this and figure that out. But he was talking about the mental shift, the emotional shift. And he related it to real estate. I just got fascinated and went, got the book, read it. And I said, okay, this is it. It might not be real estate, but there were so many concepts in there that I just had not heard before. Being an employee at a large tech company, a media company at the time, that started the pivot. And I went back to my then girlfriend, became my wife. And I said, we're doing something different. And she read the book and she bought in. Next thing I know, we both quit our jobs, moved back to Texas, and we bought a single family home. And that's what started the whole thing. So yeah, it's the purple book. It started it all for us.
Right. Yes, I've read and listened to quite a few of his things. In lots of ways, it kind of seems like he was before his time and the way he thought.
That was in 99, 98. So I think the book, he was like trying to do a media tour, public, and he was going around doing anything he could. And so I'd never heard of him, but boy, after that, I tracked his brand down and I said, I need to figure out what this guy does. And that's what kicked the whole thing off.
So now that you are where you are, what is it that the capital or the Club Capital does?
Our core business model for the past 12, 13 years, we have been funding developers for multifamily. So we sometimes co-develop and co-GC depending on the deal and the developer and the sponsor. But our primary business model it started off friends and family, raising capital and putting them in an alternative investment because they were looking for something other than just the stock market at the time.
Right.
And that's how we got started. And so as we grew, there was tremendous amount of opportunity between 2008, 9, all the way up until year and a half ago. We were undersupplied, like most of the nation, in housing. Money was inexpensive. We have net migration, massive net migration. We still lead the nation, Texas, in job creation, net migration. It was housing. So we have a pipeline full development opportunities. And we ended up selecting, you know, 4 really good developers. We kind of stayed with that group. We didn't just spread ourselves way too thin. And we just raised capital with limited partners, investors, and we funded those projects. And that's what we've done up until about a year and a half ago. And it's been very successful. Now, the reason I say a year and a half ago, because as I think we all know that are anywhere in this space, you know, interest rates are high, leverage is low, supply is a little high right now, you know, rents are flat. There's just a lot of things that kind of created the perfect tsunami for development. It just doesn't pencil out right now.
Right.
And supply's there. So what we've done is we've pivoted to a different type of equity called preferred equity. And there's a lot of people in the last 10 years that have been in this space as an investor, probably not heard about preferred equity because it wasn't really needed. You know, we all kind of said, okay, here's the senior debt, which is your loan. And then here's your common equity. And that was the capital stack. That was it. Well, because of what's going on in the market, now developers are finding themselves like, hey, I burned through my interest reserve because my interest rates were 3.5. Now they're 8.5.
Right.
You know, I burned through my contingency because things are just slower. You know, rents are down and they're looking for capital to get over the goal line, to complete the construction, to complete the lease up and get it stabilized. So we're coming in with this preferred equity and it fills the gap. And the good thing about it is for investors and for us, it's short term. So it's like 18 to 30 months. It pays double-digit returns. It cash flows on a quarterly basis. And you're getting a really good return with a Class A asset, and you sit in front of the common equity. So when the project is completed and it's time to refinance or sell the project, you are coterminous, meaning when that senior loan gets paid off, so does the pref equity in full before the common equity receives any of their returns. So you're in a really safe spot. And, you know, typically the capital stack is, let's say the lender's at 65% of the capital, we'll come in at 10 or 15, and that last 15 or 20 is the common that would be behind the preferred equity. So it's buying time and it's rescue capital, and it's really working for the developers and it's working for our investors because they're not sitting there holding cash, doing nothing. They're getting 11, 12, 13, 14% return.
Right. Now, somebody who has never invested in this type of market before, and they're just starting out, would this be an investment for them, or would that not be something good for somebody who's just starting out?
I think this is a better investment from, let's say, 8, 10 years ago, just putting your money into common equity first. And here's why. The underwriting and common equity and waterfall structure, you know, like how do you get your returns and who gets it and where's the splits and all that, that can be pretty overwhelming the first 2 or 3 that you look at and that you may invest in. You may not understand completely what that is. This preferred equity it's finite. Okay. Here's the term. Here's the return. That's it. Now, what's good about it is you're in a deal and you get to see all of the asset management reports. You get to see the property management reports. You get to see the waterfall from the common equity people, but you're not participating in it, but you get to understand it and see the operating agreement, the waterfall, the loan structure, everything. So I think it's a fantastic first deal for people that are coming into a multifamily investment because you get to see everything, you're participating, you're making 12%, but you don't have all of the other stuff that's out there. So I think it's a great opportunity.
Now, so if somebody's trying to get into this, is there a minimum that they would need to commit to investing in this?
Yeah, I mean, most of our investors do $100,000, but I tell people, because I'm so passionate about people creating multiple streams of cash flow and income and diversifying into the right assets. We personally would take 50,000 for a first-time investor. I think from a proven syndicator, most of them are going to take 100, but I would rather, let's just hypothetically say somebody had $250,000 to deploy into real estate, commercial real estate path. I tell everybody, do not put all that money with me or one person. I split it up between minimum two, if not three different sponsors, because it gives you an insight as to how that sponsor operates, how that sponsor communicates, because your sponsor is so incredibly important to your success. It's just like your coach or your management team. Those are the key people, and you get exposure to more than one person. I think that's incredibly important, especially if you're starting off just now.
Now, I guess, what are some of the common mistakes that you're seeing investors make as they're getting into this arena, or if they've been in it for a while? What are some of the common mistakes you see them making?
Well, I'll tell you, you need to go make some mistakes. I'm going to say that first. Okay. So yeah, don't be afraid of making mistakes, because if you don't get a little pain, you're not going to remember the lesson that you've learned from that mistake. So, I just tell people, gosh, you've got to execute. Don't keep reading books and thinking about it, because you'll look down 5 years from now.
Right.
But I will tell you this. I don't think younger or less experienced investors ask enough questions. And I'll give you an example. My engineer investors don't stop asking questions. And I'm grateful for that, because it sharpened my skills. Because I'm going like, that's good. I need to remember that one. But asking questions, in fact, we'll get to the end of this, but on our website, I have the top 10 questions for investors to ask sponsors.
Okay.
And I think it's a great foundational tool. They can get that off our website. No question's a bad question, of course. But there's a lot of people that are afraid to ask because they think they're going to be stupid. Yeah, ask questions. If that sponsor wants to do business with you, they should welcome every question you ask.
I think it's one of those, it's just, they don't know what to ask, because they just know that they've been told, hey, you need to diversify, put some money in some real estate or whatever. And they try to get involved, but they don't know the right questions to ask. So I think that's great that you have that resource on your website. So for somebody who's learning to go out there and find. When somebody's looking at, and you're talking about the preferred relationship now, is that something where me as an investor, am I getting, how I guess from a tax perspective, how am I getting this back through a K-1? Am I getting a 1099 for what? How does it show up?
So again, I will always tell people your tax attorney is your guy. Okay. Mm-hmm. And now we have enough experience doing these that we understand income versus capital gains and how to structure partnerships and how to make payments and when to make payments. Okay. I am a huge proponent of maximizing the tax code. However, I don't let the tax tail wag the dog, especially early on. Maybe later when you get more experience and you're talking about some numbers that are significant, then you need to incorporate that into everything you do. But for what we're talking about today, we have a K-1s or what people receive. People ought to know that the world of investing in commercial real estate like multifamily, early investors or first-time investors are going, where's my K-1? My taxes are due on April 15th. Well, I get about 30 K-1s, 40 K-1s a year, and I don't think I get all of them until maybe August, September. It's the nature of the beast. It's unfortunate. We do everything we can to get that timely, but sometimes the taxes on these are very complex, and we want to make sure we're maximizing tax efficient structures that we can to give our investors the best possible outcome. So yeah, but it is a K-1 and we have a back office and everything's hosted back there. We communicate pretty aggressively when it comes to tax season and monthly and quarterly reporting.
Right. I think that the issue with the K-1s, I think that if anybody's investing, and not just, in real estate like this, but other alternative investments, you're getting that K-1 way late.
And after people do it a few times and they say, okay, here's the benefit of it, I just need to file an extension, and just know that it's not, and it's always our guys that are in their first investment or two. They're just kind of learning how that happens. But once they realize and they take that K-1 to their CPA and they see, okay, I got some depreciation or I got some deductions or I'm not paying as much, then they go, okay, waiting a month or two or three, this is not a bad deal.
Yeah. Now, do you guys, from I guess, easing of mind for people, do you guys put out anything, like at the end of the year to say, hey, this is about what it's going to look like, so then they could do their projections, pay any estimated taxes and stuff that they may have due?
We do. We put out a draft based on all the information we have. So if somebody wants to make a payment
Yep.
and estimate, okay, I'm going to make 90% of what they say, or maybe 100, whatever. But
Right.
yeah, we do that. And it works for the most part. People appreciate that and they go ahead and make that payment. So we do that. That's good for people to know. So thank you for asking that question.
Yeah. Looking at people going into, because you said you guys did some alternative investments and stuff like that, prior. Are you guys looking, do you see anything on the forefront coming that you're going to do anything in that arena again?
Well, here's what the data is telling us. Okay. And this is where I tell people, like, look, there's emotional investing, which I don't think I've ever made a good emotional decision, period, in anything. Okay. Take it out,
Right.
look back and I go, okay, friends, family, investing. I'm going like, it was emotional. That didn't work.
Right.
Use the data. But what the data is telling us today, okay, is that we're kind of in the bottom of this kind of trough depression, whatever you want to call it. And I relate this back to 2008, 9, 10, when we had a significant financial crisis.
Right.
If you look back and everybody that was prepared in 2012-ish, give or take, the hockey stick effect took off for them. Okay. The pricing, the capital, the rents, all of that were in their favor. And we had an 8, 9 year run, and so I did not at that time pay enough attention to the data.
Mhm.
And I did not invest as heavy or got as aggressive as I should have. I'm not letting that happen again, because
Right.
what the data tells us today is we've got $600 billion in multifamily loan maturities happening this year, next year, and in 2026.
Hmm.
Well, what's going to happen on that is that these loan maturities, these developers are not long-term hold guys. They're merchant builders, meaning they're in and out in 4 or 5 years. They've got to turn that money. Well, they're going to be saying, look, I've got a loan maturity. I am not going to hold on to this asset for another 4 or 5 years, building it up for a cash flow. I'm going to get out of it. Okay. So we're starting to see right now the smart money coming in. 2 family offices, one last week and one this morning, wanting to talk to us because they realize what's about to happen and they're getting their money ready to deploy in the next 6 to 12 months. And that's that hockey stick effect we see. And I would tell everybody this, we're going to do the pref equity for a year, 2 or 3, and then I think pref equity kind of fades out. But starting probably this time next year, maybe a little earlier, you're going to start seeing these opportunities, these loans starting to mature at a significant pace. And these developers are going to say, you know what? I'm selling it. I'm not going to make a profit. I'm going to get my investors' money back. I need to churn that money again to do another one. And we're going to pick up these assets below replacement costs. And they're good assets in good locations. I mean, these are new assets. These are not 1970s, 1980s.
Right.
These are all brand new, under construction, being stabilized, rented right now. So I would tell people, I don't know. I think the professional money's staging right now to come in, but I think the people like you and I are probably need to be really aware, 6, 12, 18 months from now, there's going to be some significant opportunities. And I don't think we're going to get we got like the NASA effect on the last one, it just shot straight up. But I think we're going to see a nice ride, 26 through 30. There's going to be a lot of good deals, a lot of good cash flow.
Right. Now, I said, let's go back and put that in layman's terms for the listeners. When you're saying that, hey, there's going to be these opportunities that these developers are going to sell these projects, and you're saying, okay, they're going to be selling them at, I'm going to say, below market. What does that mean to the investor? How can they get involved and be part of this?
Yeah, super, super good question. So what's happening, and I'll paraphrase, these loans are maturing and these developers do not want to get another loan. So what's going to happen is we're going to be, here's exactly what we're doing. We're putting pref equity into deals because we want a front row seat to the game. Okay.
Right.
So we're in the deal. We're getting to watch the asset management, the property management, and the deal. We're getting paid to watch the game.
Mm.
And we're going to be in a position to take that asset over. So we have a really good way to source data for loans maturing, for developers that have maybe 3, 4, 5, 6 projects out there, knowing they can't carry all of them. They're going to go ahead and letting a couple of them go. So we're starting to kind of build our presence in this pref equity to get an insight. I told a guy the other day, I said, this is like, I hate to, when the Greeks entered Troy through the Trojan horse and, we're not going to wipe everything out, but
Right.
I said, we're a Trojan horse with an olive branch. Okay. We're coming in with this rescue capital, and then we're going to be sitting right there ready to take that asset over. Now, for the listeners here, we underwrite every asset as if we were going to buy it. So we're not just doing pref equity here and there just because it's pref equity. We want to buy that asset. So we're not putting money into a deal that we would not want to own. So that's how we're looking at it. So if an investor is wanting to get in to that, we're not the only guy doing pref equity,
Right.
but I think we're one of, we're doing pref equity. It's great. Returns 12%, let's say, but then we're going to roll that up. If you want to, as an investor, go into the deal long-term with new debt, you have that option to go with us. Or you just say, you know what, I'm out on the pref equity side and I'm good. I made my 12, 13%, whatever it might be, and I'll move on. So yeah, but Gary, we have, if you think about it, I'm in the state of Texas and then I'm in Austin. All right. I've got Dallas, Fort Worth, 3.5 miles north of us. I got San Antonio, 1 hour south. I got Houston, 2.5 hours east. I've got some of the best multifamily markets in the nation. We lead the nation in job relocations. We lead the nation in Fortune 500 relocations. We lead the nation in net migration. So we're very fortunate to be here from a multifamily perspective of it. And I just say, when you're evaluating, where you want to place your capital, it does matter. Not to say there's good deals all over the nation.
Sure.
I just think we have a concentration of them.
Right. All right, Darin, what have I not asked you wish I had? We could go on for hours with this.
Yeah,
because again, this is a lot of good information here for sure.
I get so excited about this, and I've lived it firsthand. I've all the way from Y2K.com, 9/11. How many of these can I go through? I would tell people it's going to get better soon. Working with an experienced sponsor if you want to get into this area. But I can't stress enough, it doesn't have to be real estate at all. It's just that was the path I chose, or we chose back in 2001, 2002 to focus. It is powerful to have passive cash flow, and from not just one vertical, meaning just real estate or just the stock market. It's so easy today to find 2, 3, 4 ways to create some passive income. It changed our lives. It saved our lives. It prevented me from going bankrupt, but it allowed us to raise our children in a way that most people would not have been able to. But, I can't stress enough, education without execution is just entertainment. You've got to go feel some pain. You've got to execute. You've got to get both feet in, and you just got to go. I've lived it firsthand, 24 years of experience. It works.
Right. So Darin, if people like what they hear, or they want to learn more, about this type of investing, how can they reach out to you? How can they learn more?
Well, thank you. The easiest way to do it, we're clubcapital.co, not com.co, Club Capital. And I would encourage everyone to grab the pref equity kind of 101 and then the sponsor questions. There's 10 of them there.
Mm-hmm.
The pref equities, I think, excellent. You asked this question at the beginning. I think if I had pref equity, 20 years ago as my first opportunity, I would have jumped on it quickly.
Right.
But the pref equity and asking the questions, and we reinforce that. Those documents are both on the site and clubcapital.co, and my cell number's on the site too. Feel free to, I love it, especially when I get younger people that call me and say, hey, can you tell me what to do? And I'm not going to tell you what to do, but I'll point you in the right direction.
Right. Right. That's great. Darin, I really appreciate your time. I think that this is something that a lot of our listeners need to hear. And just finding that there's more opportunities out there for passive investing, I think is important for people to know.
Well, Gary, I appreciate what you do.
Thank you very much.
All right. Thanks, Gary.
Yep. This week, our guest was Darin Davis, and he is the principal at Club Capital. I will see you guys next week.
49 faces looked to him in triumph. Over the last 12 months, they had each taken turns and promoted his business for a week at a time, driving over $987,342 in revenue. What if you had a network of 50 centers of influence who promoted your business every week for a year? Grab your copy of the #1 Amazon best-selling book, The Ultimate Guide to Growing Your Business with a Podcast, at 33% off the Amazon price by going to ultimatepodcastbook.com. Again, that website for 33% off the Amazon price is ultimatepodcastbook.com.